you to share your screen. So Donghwa Shin from North Carolina at Chapel Hill will talk to us about extrapolation and complexity. So Donghwa, the floors are yours.
Can you hear me, by the way? Yes?
Very well.
Okay, great. Thank you very much for including my paper on this wonderful program. My name is Donghwa Shin. I'm an assistant professor of finance at UNC Keenan-Flagler Business School. Today, I'm going to present my paper, Extrapolation and Complexity. And in this paper, I studied the market for structured retail products, a type of complex financial products that package complex exotic options and bonds. And interestingly, these complex products are sold to unsophisticated retail investors. And I'd like to start my presentation with a very simple figure that has motivated my research. The blue line on the left figure shows the annual sales volume of equity-linked structured product issued in all countries. It was just about $50 billion in early 2000, but this market has grown rapidly over time. So in 2015, we observed $250 billion of equity-linked structured retail products. There are various types of structured products in this market, and I'd like to highlight one specific type of structured products called auto-call, which is known to be one of the most complex type of structured products. The red line on the left figure shows the market share of auto-call, and the market share of auto-call was pretty small in early 2000. But as you can see, it increases rapidly. So in 2015, the market share is about like 50%. And this pattern is observed in most of the major structured retail products market. United States, the biggest equity-linked structured retail product market, shows almost the same pattern. So the main takeaway from these two figures is that there was a rapid growth in sales volume and complexity. Then why do unsophisticated retail investors buy complex products? And there is an important conceptual gap between the existing finance literature and the empirical pattern that I have just shown you. The existing finance literature has focused on the hypothesis of financial intermediaries using complexity to exploit retail investors' lack of sophistication. Of course, such exploitation behaviors by intermediaries are clearly relevant and capture an important characteristic of this market for sure, as documented by many great papers. But it is still a bit puzzling to see that investors show even greater appetite for structured product after a long period of being deceived or exploited by financial intermediaries, because they can eventually recognize it. In addition, exploitations assume some kind of investors' behavior biases. Therefore, it is quite important to seriously study this behavior bias. And I built upon the literature of exploitation. I feel this conceptual gap and add to this growing literature by studying the role of investors' extrapolation bias. And before I explain about my main empirical finding, it is worthwhile to think about how bounded rational investors deal with financial complexity. Bronnemeyer and Oenke suggested multiple heuristics. For example, investors can use divide and conquer. They can divide the complex product into several pieces that are relatively easy to analyze and combine them together to deal with complexity. Another possibility is to use a simple model. Then, what if investors cannot use any of those simple heuristics because products are very, very complex? And I conjecture that in that case, maybe investors rely more heavily on even simpler approach, which is extrapolation. What is extrapolation? Investors with extrapolation bias estimate future returns of financial products based on their past returns. And why do I focus on extrapolation in this study? Because it has been successful in explaining the behaviors of return in stock market compared to other behavioral finance theories. So it is quite plausible to expect that investors exhibit extrapolation in equity-linked structured products market as in the stock market. And here's my main hypothesis. Investors buy more structured product that provided higher past annualized return. And this is the simplest form of extrapolation, and I'd like to go a little further. Investors respond more aggressively or more sensitively to the past return in purchasing more complex products. And here's a preview of my main empirical findings. First, extrapolation is prevalent. Investors purchase more structured product that provided higher returns in the past, even though past returns do not predict the future performance of structured products. And not only that, interestingly, investors exhibit stronger extrapolation for more complex products, which is novel. And in the second part of my paper, I study the behavior biases in this market more seriously by studying extrapolation bias and salient thinking together. Investors with salient thinking are attracted by a salient feature of structured products called headline rate, which is the maximum possible return that investor can enjoy. And I first find that both extrapolation and salient thinking are important in explaining the sales of structured products and their economic magnitudes were comparable. And interestingly, they seem to be independent drivers because past returns and headline rates are almost uncorrelated. And both extrapolation and salient thinking are crucial in explaining the growth in sales volume and complexity, which was the motivation of this study. I find that more complex products perform better exposed by chance in my sample period, and more complex products offered higher headline rates. By combining all these empirical facts and extrapolation and salient thinking, we can explain the growth in the sales volume and complexity in this market. Then, in the presence of behavior biases, including extrapolation and salient thinking, how do a financial intermediary react in terms of pricing? I estimate the annualized markup of large sample over 34,000 structured retail products, and I find that on average, annualized markup has decreased and the number of active issuers increased over time. But it is important to note that annualized markups for some type of structured products, right, like reverse convertible and auto calls, are still not very low, as Petra just showed. And another thing that I wanted to study is whether there is a strong evidence that issuers take advantage of extrapolation bias through pricing, which means whether they charge higher markups for the product that provided higher returns in the past. And I don't see such evidence. And in the last part, I was still curious about why for some product, why the annualized markup are so high. And the dominant view is exploitation. And what I wanted to do in the last part is, okay, after controlling for exploitation, whether we can find another mechanism that explains the high markup. And I find some suggestive evidence of post-op hedging, and this seems to be an important factor that also explains the high markup. And I will show you three main examples of structured products. One is the participation products. And if you buy these products at the end of maturity, when underlying assets return is 10%, rather than receiving 10%, investors receive only part of it, let's say 7%. Then what's the benefit of buying this product? The benefit of buying this product is their principal is fully protected. So another interesting or very important type of structured product is reverse convertible that Petra has already explained. So let me very, very briefly explain what it is. When investors buy this product, they receive some high coupon. In this example, 8.5% of annualized coupon. And then how is the payoff at maturity determined? First, we have to keep track of underlying assets performance, and if it hits this knock-in barrier, which is minus 30%, then investors are likely to lose money because they only receive final underlying return at maturity in this case. However, if this event doesn't happen, then investors' capital is fully protected. Then how is such high coupon be generated? How is the coupon, such high coupon is obtained? So if you take a look at the payoff structure around this knock-in barrier, you can think that this looks like the short position of the put option, right? So when investors buy this product, they implicitly sell the put option, and in return, they receive high coupon in normal time. The last example is auto-callable product, which is known to be one of the most complex type of structured retail products. It looks much more complicated, right? And when investors buy these products, we have to check the underlying assets return at the end of these put call dates, in this case, at the end of every quarter. So at the end of the first quarter, for example, if underlying return is larger than knockout barrier, which is 0%, the investors receive 6% of the coupon and this contract is terminated on that day. Or we can say that this product is automatically called by the issuers, therefore the name of this product is auto call. If this condition is not met, then we have to check this condition again on the second call date, and we have to do it over and over if it continues to fail to be called. If the product has not been called until maturity, then we have to check the underlying assets performance over time again. And if it hits a knock-in barrier, then investors is likely to lose money. Otherwise, they receive a huge amount of coupon. So at some point, anyway, if this bad event, this knock-in event doesn't happen, then investors receive this 24% of high coupon at some point. And the reason why I'm saying this is one of the most complex product is because it's very hard to apply simple heuristics to analyze this. This is so complex, so you cannot decompose into separate pieces, or there's no simple closed form formula to price these complex products, whereas that is possible in other types of structured products. Data, I use OTC equity-linked structured products issued in the United States between 2001 and 2016, and the number of product is over 71,000, and I combine this with market data. And there are some main challenges. First, pay-up description of structured products are all written in plain English, so I had to apply this text mining technique to convert this pay-up description into a machine-readable format. The second challenge is the structured products are not standardized at all, so no same product is issued repeatedly. Therefore, relating the past return for a specific product to its future sales volume, which is essential for testing extrapolation, is literally impossible. So what I did is, in order to overcome this, I categorized structured products based on their payoff structure first, and I further subdivide each category based on underlying assets and issuers, and construct the group level variable each time by taking medians of product level variable. So basically what I did is, using this grouping technique, I constructed kind of panel data. So one of the most important variable for sure is financial complexity in this study. I proposed complexity autocall. This is a dummy variable that is equal to 1 if a structured product is an autocall and 0 otherwise. And this is based on the idea that autocall is one of the most complex type of structured products. And I also use other two complexity measure, and I follow Vallée and Vallée QJ 2017, and I count the number of scenarios in the description of a payoff description. For example, if you take a look at the left figure, we can see that there are two scenarios. If underlying asset is negative, we have flat line. If it is positive, we have positive slope, right? So the number of scenario in this case is 2. If you take a look at the right figure, by the same logic, the number of scenarios is 3. Another simple measure for complexity is number of characters. I just count the number of characters that are used in payoff description, and this is based on the simple idea that if the products are more complex, it is likely to have more words per character in its description. And all these complexity measures seem to be quite highly correlated, and their correlation coefficients range from 0.7 to 0.74. Main variable, I first compute the annualized realized return, which is a measure of ex-post return. After collecting the information of a coupon and capital return using text mining technique, I use this IRR formula to compute the annualized return. And past return, historical price of structured product is not available because by definition, this is OTC products. So what I did is I assumed that price at time t should be the same as fair value of structured products, where fair value is estimated using Heston's volatility model for this purpose, or geometric Brownian motion. And but using this assumption, I compute the past 1 year return. On volatility, I generate the sample path using some assumption on the underlying asset. And for each path, I compute annualized realized return and take the standard deviation of them. And probably the most important variable in this study is this annualized markup. For this, I use static replication and local volatility model together. So if possible, I use static replication, which means if a structured product can be replicated using simple long-short strategy of option and bonds, then we just simply sum the price or cost involved in taking those positions. That is a way to compute the fair value. And if that is impossible because products are rather complex, then I calibrate local volatility model based on Andreessen and Hughes. And I define the annualized markup in this way. First of all, markup is defined to be price minus fair value of structured product at issuance FV0 divided by P. This is the definition of markup, and I divide it by expected duration of structured products under Q. And this tau is definitely the same as the stated term for most of the products, but this is smaller than the stated term for autocallable products because its expected lifetime or expected duration is smaller than the stated maturity because of the possibility of being redeemed early. Extrapolation. In order to test extrapolation, ideally, one would examine whether the returns on product type L observed by customer C predicts future purchases of product type L by customer C, ideally. However, the necessary data are not available. So here, in order to address this concern, I use this assumption. The matching between issuer and a customer is likely to be stable, which means a Morgan Stanley customer is likely to remain a Morgan Stanley customer in the future because the switching between different issuers is quite costly for the retail investors. So I studied for each issuer the relationship between past returns of product type L and sales of product type L, because past returns on product type L issued by Morgan Stanley captures the average past experience of Morgan Stanley customers. Therefore, they should predict future sales purchases of product type L by Morgan Stanley customers. So this is the main baseline result. I define the dependent variable normalized sales, which is by definition sales divided by outstanding volume at previous period. Here, outstanding volume is the volume of structured product that were issued in the past but have not yet been matured. And I take log 1 plus in order to guarantee that my results are not driven by the outliers. And if I regress it on the past return, the coefficient is positive and statistically significant and economically significant. One standard deviation increase in past returns translates into 4.3% increase in normalized sales, where standard deviation of normalized sales is 26.8%. And interestingly, investors exhibit stronger extrapolation for more complex products. If you take a look at the second column, the interaction term has positive coefficient. One standard deviation increase in past return for autocall, which is known to be one of the most complex type of products, translates into 8.7% increase in normalized sales. And after putting several control variables and adding lots of fixed effect underlying quarter and issuer fixed effect, I still observe a similar result. Robustness check. Are the baseline results robust to the specific choice of the dependent variable normalized sales? Yes. I define a new dependent variable log market share. And the result, if I replace the dependent variable with this new dependent variable log market share, the results are qualitatively similar. And is the definition of main right-hand side variable past return reasonable? The advantage of using current definition of past return is that we keep the horizon for past return to be exactly the same as 1 year. However, some people actually recommended me to use actual realized return rather than sometimes unrealized return. So what I did is I only use this realized return, which is realized in the previous period. And I take the median of them and I observe the qualitatively similar results. And coverage of the database, the coverage of this database is quite exhaustive. As Petra showed, it covers more than 92%, and it becomes even more exhaustive in the latter part of the sample, over 95%. So I did subsample analysis with the latter part of the sample, and it yields almost identical results. One more interesting thing that we can check is whether this extrapolation, the results of the extrapolation is driven by financial advisors, which means that our financial advisors who know that investors are subject to extrapolation bias, they can intentionally push only the product that provided higher returns in the past. So in order to see whether these results are mainly driven by that, I use Egan, Matikos, and Sero's paper, who documents heterogeneity of persistent financial misconducts across different firms and lists top 20 firms with highest incidence of misconduct. And what I did is I just excluded the structured product that were sold by the company in this top 20 list, and I find the very similar result to my baseline results. And this partly alleviates the concern that the results of extrapolation is entirely driven by financial intermediaries' misconduct. Is it driven by rational expectation? Petra shows that there is a little chance that the demand for structured product is explained by rational expectation, and this is another evidence. Past returns do not predict the future returns at all, and it is quite costly to trade structured product actually, because there's no secondary market. So it is quite unreasonable for anyone with useful timing information to trade structured retail products rather than underlying asset or its option. And there are many multiple survey findings that support this, that is consistent with investors' behavior biases. And in the second part of the paper, I study extrapolation and salient thinking together. Before I explain about that, I will first show you the exposed performance of structured retail product measured by this annualized realized return. And if I compute the annualized realized return of the whole sample, which is 51,606, we find that it is 3.2%. And what's interesting, first of all, this number is really low. If we take a look at the other benchmark like S&P 500 or even bond yield. However, if you take a look at the returns of different types of products, we see some variation. Autocallable product performed pretty well, provided 7.6% of the return, whereas reverse convertible provided very poor return. And participation products group provided somewhat modest return. Given the complex nature of structured product, it is plausible to expect that investors' decision-making process can be very complex, so they are probably subject to multiple behavior biases. So in this section, I jointly study extrapolation and salient thinking with yield enhancement products. Vallée and Vallée show that investors are attracted by high headline rate in their decision-making processes. So I regress this normalized sales on the past return and headline rate, and as you can see, in various specifications, the coefficients are positive and statistically significant. First, let me summarize the main takeaway from this section. First, both past return and headline rates are important in explaining the sales of structured products. One standard deviation increase in past return translates into 5.2% to 7.2% increase in normalized sales. And if we increase the headline rate by one standard deviation, we observe a similar range of increase. Even more interesting thing is they're independent driver in a sense that correlation between the past return and headline rate is very low. It's minus 0.119. And this extrapolation and salient thinking are crucial in explaining the growth in sales volume and complexity, which was the motivation of this study. As you can see in this table, Autocall offered 1.5 to 1.6% more headline rate than reverse convertible. And as we have seen before, Autocall delivered about 10% more annualized return than reverse convertible, which is consistent with this pattern. Here I plotted the market share of autocallable product with red line, and the red dashed line shows the market share of reverse convertible. Market share of autocall, as I have shown you before, is increasing over time, but market share of reverse convertible is declining steadily over time. It was very high. The market share was about like 40% in early 2000, but recently it's just about like 10%. So the sales of yield enhancement products are quite consistent with the hypothesis of extrapolation and salient thinking, and sales of some other types of products are also consistent with extrapolation. In the last part of the paper, I wanted to study how, in the presence of such behavior biases, including extrapolation and investors salient thinking, how the financial intermediaries reacts in terms of pricing. I first computed the annualized markup for 34,257 structured retail products, and as you can see, if you take a look at the median and average, it has been declining over time. It was pretty high, about like 9% in only part of the sample, and it's declining. So it's about like 4% in between 2015 and 2016. And in order to understand what's really going on here, I decomposed them into different categories of structured products. And as you can see, participation products charged very small markup. On average, they charged about 1.6% of the markup. It was about 2.2% in early period, but it decreased to 1.4. So we see some declining pattern. What about reverse convertible? Reverse convertibles markup was very high in only part of the sample. It's even higher than 10%, but it's declining over time. Although, even though it declined, it's not yet small. It's not yet very low enough. What about autocallable product? It was about 7% in only part of the sample. It shows some decline, like more than 1.5% of the decline, but still the magnitude of annualized markup for autocall and reverse convertible seems to be high. And during this same time period, the number of active issuers who issue more than $100 million of structured product increased from 5 to 18. So the market becomes relatively competitive, and overall pattern is that the markup is becoming smaller, but for some products, the markups are still high. And in this section, I wanted to see whether issuers take advantage of investors' extrapolation through pricing, which means whether they charge higher markup for the product that provided higher returns in the past. And what I found is actually they slightly lower markup, although the economic magnitude is somewhat small. So at least what we can say is issuers do not take advantage of extrapolation through pricing. The last part is probably all of us, all the audience today is very puzzled why we observe such high annualized markup. We can speculate a lot, and I wanted to push this a little bit. Built upon the literature on exploitation, we can confidently say that significant portion of annualized market could be driven by exploitation, and the rest is something else, right? Including cost of hedging. And what I want to do is, because the effect of exploitation has been very extensively studied already, I want to study some other part, which is related to cost of hedging. And here's my identifying assumption. When an issuer sells two different products, which have the almost identical payoff structure and almost identical expected duration, and the only main difference is underlying assets, the issuer cannot better exploit investors with a specific underlying asset. Oh, because I picked this specific underlying asset, I can better fool my investor, fool my customer. That is not the case. That's my identifying assumption. Under this assumption, by using issuer times time times firm, a term fixed effect, I can control for issuer's exploitation effect, right? So I'm not very ambitious to quantify exploitation effect, but what I'm doing now is controlling for exploitation effect. And I regress the annualized return on index dummy and liquid index dummy. So index dummy is equal to 1 if underlying asset is equity index. Liquid index is equal to 1 if underlying asset is one of the three main indices, S&P 500, Euro Stoxx 50, and Russell 2000. And as you can see, you see all the negative number, 1.2% and 1.5% of lower markup for participation product if they have index underlying asset, and 4.0 and 5.7% lower markup, autocall 1.2 to 2.6% lower. And given the standard deviation and mean of them are quite comparable, these numbers are economically significant. And this actually number I think makes sense because it is somewhat consistent with Vallée and Vallée. Based on their observation, the upper bound for average annualized markup for Euro Stoxx 50 linked yield enhancement product was between 2.5 to 3.6%, which is consistent with this finding. And here I further controlled with complexity measures and Harpindale index to control for complexity and competition, and I still observe the similar results. What's even interesting here is 95%, 1.2%, and 11% of the participation products, reverse convertible and autocalls, are index linked, which this proportion is inversely related to average annualized markups of each group. And this suggests that cost of hedging could explain some non-trivial fraction of high annualized markup of structured products on top of exploitation. So the important implication is even if market grows and therefore becomes more competitive, it is not clear that such purely market-based mechanism alone should decrease the level of annualized markup significantly. This study identifies an important behavior bias that investors rely on in investment decision on complex financial products. Using structured retail products market as an ideal laboratory, we find that extrapolation is prevalent, and extrapolation, along with salient thinking, contributes to the rapid growth in sales volume and complexity observed in this market. We found some declining trend of markup, but we know that some of them still have high level of markup. In order to explain, I show that there is some evidence of cost of financial friction or cost of hedging. Yes, that's it. And I look forward to Boris Vallée's discussion.
Thank you very much, Donghwa. If you can release the screen, Boris Vallée is going to discuss this paper.
Yes, thank you very much, Christian, for inviting me to discuss this paper. I mean, I was very excited to see a full session on retail structured product. Obviously, it's a topic that is dear to my heart, and so I'm very excited when I see other people working on these topics. All right, so let me just take a quick step back on this product. I mean, as was mentioned, this is a large market. So since its inception, there's been more than $5 trillion of issuance. And I think what is quite interesting as well is that it is a very global market. So it started in Europe, but it spread to the US, and now in Asia, it is particularly active in Korea, in China. So in itself, this is really a successful market. But what makes this market particularly interesting, in my view, is how complex the product can be and innovative. So the magnitude of innovation and also just the sheer number of innovation, because there is so many different products, is particularly interesting, especially when you contrast it with the sophistication of retail investors, because we know that the average retail investors is not particularly sophisticated. So I think in general, this gap is very interesting to understand, and is definitely a strong motivation for this literature. But what I might find the most compelling about this market is that it's a great laboratory to study the cause and effects of security design. I mean, there is a somewhat old literature on the risk-sharing motive for security design. But I think recently we've been thinking about security design in a much more behavioral way, which has opened many doors. And so when we think about security design, and I think we've been talking a lot about that in this session, but it is a powerful tool, and it can be used with different goals. And so one obvious goal, or at least one obvious after this session, is that this can be used in an exploitative way to exploit the behavioral biases, to create friction, exploit asymmetry of information, and so on. So this is more on the dark side of the security design. But on the other hand, this flexibility in design could and can also be used for a more noble purpose, which is to mitigate and alleviate behavioral biases of retail investors. And so I think it's particularly interesting to understand when one is happening or when is the other happening, what is driving that, and what are the effects, hopefully being able to talk about the welfare effect, or at least the surplus effect for the investors. And so this paper is gonna lies in the mostly dark side piece of this literature. But again, I think having a nuanced approach is quite key here. All right, so what are the main results of this paper? So as the title indicates, the central result is that past return of a given structured retail product predicts the sales volume for new issuance. And importantly, as Donghwa mentioned, this is done, the relations are done with issuer fixed effect, because obviously the client base is somewhat sticky. So within the same client base, we are measuring how much response there is to the past returns. And so this relationship is consistent with extrapolation on the end of investors, but might also be consistent, or at least, I mean, this extrapolation might be fostered by the marketing strategies of institutions. Then Donghwa also shows that past returns on sales do not predict future returns. Then past returns relationship to sale volume is more pronounced for complex products. And last, and I will talk about that, I mean, it's not as tightly connected, the last result, but importantly, markups are large. They are negatively correlated with past performance and decreasing over time. All right, so as I said, I was very excited to read the paper, and then of course I started thinking about how does it fit in the literature on which I've spent many years of my life. Where are the possible space for maximizing the contribution for this project? So I think the first space is in providing a different or complementary mechanism from the existing literature for explaining the strong demand and sometimes even puzzling demand for complex products or non-linear products. A second space is to take a strong stance on the catering versus exploitation debate. Because, I mean, some of the paper in the literature are very strongly worded, but when you look at the detail, it is usually quite difficult to exactly disentangle whether this is catering to preferences or whether this is more exploitative and more rent extractive in nature. And I know that, for instance, Petra and my colleague Mark as well, they show that these products are dominated by other products. But the question then becomes, how easy is it to access these other products? And so even if I'm coming with a less attractive product, if it's much more easy to invest in, then the exploitative story is a bit harder to exactly make. So the main mechanism that Donghwa has in mind is exploitation. I think here I encourage him to differentiate it from what is described in this paper that I don't think is citing, that is looking at how the design of this product seems to focus on underlying asset with specific characteristics, so either past performance or volatility or historic volatility. And then when we think about extrapolation, I think it's always interesting to wonder whether there is something specific about the laboratory that we are looking at, or is the message generalizable to stocks and other asset classes? How should we think in a broader sense? Then taking a bit a step back from these weeds of retail structured product, I think there is room for speaking to financial innovation in general, and maybe what I call the life cycle of financial innovation, because Donghwa is looking at the time series of a given innovation here. And so I think understanding how profitability is evolving, or understanding what makes some innovation stick and some disappear. I mean, this is something very interesting that we don't know so much about, because I think we all observe that some good innovation disappear and some bad innovation stick. And so I think better understanding what makes them stay or disappear is something that is quite valuable. And so, I mean, I often take the example of ETFs. It took decades for them to take off, whereas ETFs obviously makes a ton of sense for economists. Robinhood, it makes no sense to have a retail investor speculate on the stock market while queuing for their food. But the latter is much more, at least much faster successful than the former. Then I think, I mean, related to this point, identifying a disciplinary force for financial innovation and the profitability of innovation is also quite interesting. And then there is also always a question which I think we somewhat touched on the previous paper, which is how should we think about the sample period? How should we think about external validity versus are we looking at one piece of the cross-section of how any innovation can develop? Okay, so this was at a high level. Then let me dig slightly more on the point I touched. So my first comment is on whether we are looking at a different mechanism from silent thinking. So first, I want to stress that complexity, I mean, we shouldn't think of it as a byproduct of some other motive. It's not like investors, they love complexity for the sake of it. So when we say catering to households through complexity, this is not because they love complexity. This is because complexity allows to offer them some things they like. And in that case, it allows to offer them a high headline rate, a high yield, at least promised yield, which is what investors have appetite for. And so in the paper in table 6, there is a horse race between the extrapolation mechanism and the silent thinking type of mechanism by including both variable as explanatory variable. I think there, I mean, at least my understanding of the magnitude is that the coefficient on the headline rate seems much larger than the one on past performance. And so I think this needs to be at least discussed and better understood, whether we are looking at something that is second order to silent thinking or whether this is comparable in magnitude. And beyond this hierarchization, I think we can also think about complementarities. And here, Donghwa, for complementarities, he interacts complexity with extrapolation. I mean, as I mentioned in my first point, I think complexity is just the byproduct. So I would encourage to do the interaction on the headline rate with the past performance to better explore this possible complementarity, which I think is very interesting because in general, understanding the context in which behavioral biases kick in are particularly interesting because we know everyone has biases. And we know that biases matter, but when do they matter, and to what extent, and how are institutions strategic about playing with this context? I think is very interesting and not that explored yet. Let me move on because I have a lot of other things to say. Okay, so a second result is that past performance does not predict future performance. And here I feel that the writing might need to be a bit adjusted in the sense that it would be very surprising if this was the case. That would mean, I mean, this is what we teach our students, and this is what financial advisors are forced to disclose to their clients repeatedly. And so if there was a violation of this principle, like that would mean something really bizarre or wrong is happening. And so I think this needs to be a bit framed in this way. In the sense that I don't know how surprised we should be. At least if I should be surprised, I mean, I would need to understand better why I should be surprised by this. I think this is slightly different here because of the specific definition of past performance. I mean, past performance being inferred from fair value calculation. I mean, there could be some mechanical effect going on, but if anything, that would be a red flag. And so maybe this should be more presented as reassuring that we are looking at a right definition of past performance. But as I said, I think at least, I mean, these facts, it does speak to the role of extrapolation for a given innovation to survive, if it indeed does generate demand, whereas it does not predict future performance. And so that could fit into this objective of understanding why certain innovations take and others disappear. Okay, so I mean, the paper is definitely framed around exploitation. The language is quite strong in the paper. And if I may, as someone who's been beaten up by referees, I advise caution with using strong language in general. I think this language is partly explained by the large markup that are described in the paper. But it's not completely clear that these markups result from the exploitation of extrapolation. Because actually, when Donghwa regress the markups on the past performance, the sign is opposite to what this would imply. And therefore, I mean, that removes an important piece of the narrative, I think, or at least an expected piece of the narrative. And therefore, that raises a bit the question is like, are we really looking at an exploitation of the bias here? If the cross-section of markup is going the exact opposite way than what this would predict. And I think another interesting point that Donghwa somewhat alluded to is to think about the role of brokers and biases. Because here there is an opportunity, I think, to link to the literature on debiasing. Do financial advisors debias their clients? Or, I mean, the literature suggests that it's more the opposite, is that they encourage the biases because it makes their job easier at selling products. Then, I mean, it's a bit into the weed, but my understanding of the result is that they come a lot from this auto-callable product. And for the one of you that are familiar with auto-callable, the maturity of auto-callable is stochastic. So given certain conditions, you can have a maturity of 1 year or 2 years or 3 years or 5 years and so on. And so I think that creates a bit of a measurement issue when we scale the markup by the realized maturity. Because typically these products, they will trigger after 1 year, but the markup is coming from the possibility that it goes to 5 years. And so that somewhat inflates the annualized markup. And so I'm not sure exactly how to address that, but I just want to point that out as a potential limitation of doing an apple-to-apple comparison for different designs. Then I think there is this very interesting result that, as I say, it doesn't perfectly fit into the overall narrative of the paper, but I think this is very interesting, is that markups go down over time and quite significantly for some design. And so that suggests that there is a disciplining force happening in this market. And so I think understanding exactly what is this disciplining force, is it regulation, is it competition, is it something else? I mean, is it, let's be crazy, investor getting more sophisticated? I mean, all this, like answering this question, I think would be super interesting. And to the best of my knowledge, there is really nothing in the literature about that. That ties to my broader motivation, which is understanding the context into which these products could be more beneficial to retail investors. And so I strongly encourage Donghwa to think a bit more about that. I have a few small comments, but this is more for the form. Let me just move to my last word. So as I said, I mean, great pleasure reading the paper. I felt a lot of sympathy for the author because I saw some challenge he was facing in terms of methodological choice, in terms of pedagogy, because there is just so much institutional detail. So how much into the weeds should I go versus presenting a synthetic message. So I am definitely very sympathetic to all these challenges. I think finding a narrative that fits all the stylized facts is also something that is quite common in this literature. I mean, it's a challenge commonly faced. So I just want to keep encouraging the author in putting up some effort into that. So, because I think there is still some work to do on the paper, but I see several promising directions that I've tried to stress in my discussions, and so I'm looking forward to reading the next version of the paper.
Thank you very much, Boris. This was a very rich discussion, very insightful. While Donghwa is answering quickly, if you have questions, we might have time for a few of them before we hit 2:15, so you can manifest yourself in the chat, Donghwa. I want to speak back to Boris.
Yeah. First of all, thank you for very rich discussion, and there are so many things you mentioned, and I think they are all variable. And I think one of the most important, I mean, in terms of the contribution and in terms of how to speak to the literature, I think understanding the life cycle of innovation, financial innovation, this is quite interesting because I not only just show the tables of regression, and I also try to explain some variation of what's happening to the different types of structured products. So I'll also try to make some more progress on this slide. And you talked about the interaction between headline, and first of all, in terms of magnitude of headline rate and economic magnitude of headline rate and past performance, although there is some difference in the magnitude in the coefficient, regression coefficient, if we use because the standard deviation for headline rate is quite tiny, so if we actually compare how much the sales increase as we increase the past return by 1 standard deviation and headline rate by 1 standard deviation, the magnitudes are similar in that sense. But what's very interesting is studying the interaction between headline rate and past performance. I was also thinking about it, and I'll try to push to this direction a little more. And yeah, broker. Another thing that I wanted to do was this: whether I can study this structured products market by combining the data from the misconduct of financial advisors. So what I did is I first cleaned the data for financial misconduct, which has been used by Mark Egan's paper, the market for financial misconducts. And I computed the misconduct level by brokerage firm. But unfortunately, due to the limited time, I couldn't actually merge it with my data yet. But what I wanted to do is whether the firm with more financial misconduct in general, they show stronger evidence of exploitation or something like that. I have some very limited results on that because I excluded some very, very bad firms from my sample and see whether my the result hold. But what I want to see is whether actually the firms with more misconduct or known for more misconduct actually show some stronger exploitation, in a sense that they exploit headline rate or they exploit the salient thinking or extrapolation more than other firms. And you told me that the markup, yeah, I use the annualized markup. When I annualize, I use expected duration. But you're right in the sense that, first of all, my analysis is restricted to some small set of sample, in a sense that I computed the markup for the product whose maturity or stated maturity is less than or equal to the maximum maturity of the option. Therefore, because annualized markup shows some inverse relationship with the length of the term, we actually ignore a big chunk of structured product that has long maturity. But my experience is longer maturity product has much smaller markup, annualized markup. So I would say I overestimate markup in a sense. But one of the challenges, there is some estimation error. If I estimate the markup of the product whose maturity is longer than the maturity of the option, then there is another problem. But I'll think about how to address this and make some progress. And yeah, that's it. And yeah, I will try to address most of your concerns in the discussion in my new version of the paper. Thank you.
Thank you, Donghwa. Thank you very much, Boris. It was very insightful. Unfortunately, we'll have to take this discussion online. We kind of went over the question time already. Well, thank you all for